I want to begin with something most investors learn only after the market has already taken their money. When a market starts falling under machine pressure, your opinion does not matter, your intelligence does not matter very much either. Your feelings matter least of all. If you are standing in front of a liquidation machine and telling yourself that the company is good, the economy is fine, the chart looks oversold, or the drop feels unfair, it does not negotiate with your conviction. It does not pause to hear your thesis. It simply sells through the level, triggers the next system, drains the next pool of liquidity, and then does it again. That is the part ordinary investors do not understand until they have been run over. They imagine markets are still moved mainly by stories, by analysts, by reasoned human judgment, by some broad democratic conversation between buyers and sellers. They think if enough smart people can see value, value will stop the decline. That is a comforting idea. It is also dangerously incomplete. When the market enters a machine phase, what stops the decline is not value alone. What stops it is exhaustion. One more seller runs out. One more trigger is passed. One more forced program finishes. One more layer of hedging burns itself out. The bottom is not made when people feel brave. It is made when the cascade finally runs out of fuel. I have made a great deal of money by understanding a simple truth. In the market, there are times to think like an owner, times to think like an insurer, and times to think like an engineer. In a machine-driven sell-off, you had better think like an engineer, because if you do not understand the gears, you will mistake a trapdoor for a bargain. I have watched investors do this for decades. They call themselves long-term investors, right up until the first hard downdraft. Then they become amateur macro forecasters. Then they become desperate dip buyers. Then they become forced sellers. The sequence is almost comic if it were not so expensive. A man buys a basket of stocks because he believes in innovation. The basket drops. He says it is temporary. It drops more. He buys more because he wants to prove he is disciplined. Then volatility expands. His stomach tightens. The headlines worsen. The dollar rises. Bonds move against him. His account starts flashing numbers that are no longer abstract. And suddenly, the noble long-term investor is checking futures at 2 a.m. like a frightened day trader. I do not say that to mock him. I say it because most people do not lose their money in a crisis by being stupid. They lose it by being structurally unprepared for the way modern markets actually fall. The market most people imagine is a voting machine. The market in a cascade is a pressure machine. That is the mother line I want you to hold all the way through this. You are not watching a debate. You are watching a pressure system. Thresholds break, programs sell, liquidity thins, dealers hedge, volatility rises, more programs sell, the dollar tightens, the whole sequence. Then the public, seeing motion without understanding mechanism, mistakes acceleration for new information and begins adding panic to structure. That is how a manageable decline becomes an event. The first mechanism in that pressure system is what I call the threshold machine. A great many large pools of money no longer operate by sitting around a table and calmly asking whether Coca-Cola is a fine business. They run rules. If this level breaks, sell. If that trend reverses, reduce. If momentum flips negative, go short. If another line is crossed, sell more. That is how the machine behaves. In the material I studied for this, the trend following systems had already sold roughly $55 billion of U.S. equities since the beginning of the month and had been pushed into a net short posture of a little over $18 billion. What matters even more than what they already sold is what they are prepared to sell next. In a flat market, the estimate was roughly another $10 billion of global equity selling in the following week. In a down tape, about $25 billion if weakness extended through the next month. The path pointed toward roughly $40 billion more. That is not emotion. That is conditional inventory waiting to become reality. Now think like an engineer, not like a cheerleader. If you are standing near the last threshold and the market is leaning on it, you do not tell yourself a nice story about quality and then act surprised when the machines punch through it. You ask the only question that matters in that moment. If this floor gives way, how much program supply sits beneath it? That is how serious people look at a falling market. The second mechanism is what I call the liquidity vacuum. Prices do not fall hard merely because people want to sell. They fall hard when there are not enough real buyers close enough to the market to absorb the selling without a large price concession. In plain English, a weak market becomes dangerous when the room is thin and one large body starts running. I have always preferred businesses with deep moats. In a sell-off, what matters is not the moat around the business. It is the depth of the market around the stock. If the order book is thin, the machine does not need that much force to move prices a long way. The material I looked at suggested top of book liquidity sat in roughly the lower quarter of its recent range, around 6.75 million, which sounds like a nice number, until you realize it means the market can be pushed around more easily than most investors appreciate. When liquidity is thin, even ordinary selling becomes dramatic. When liquidity is thin and machines are active, ordinary selling becomes contagious. That is how you get those ugly intraday swings that make investors believe something mystical is happening. It is usually not mystical. It is mechanical. A relatively modest amount of forced activity is hitting a relatively small amount of available absorption. You can think of it this way. A healthy market is like a deep harbor. Large ships can move in and out without changing the water level much. A stressed market is like a narrow canal. One nervous move and the banks start scraping. The third mechanism is the gamma trap. This is one of those subjects that gets explained in language so ugly that ordinary people give up halfway through and tell themselves it must be for professionals only. It is not. The idea is simple enough. A great many option positions create a situation where dealers must buy or sell the underlying market as prices move. In a calm environment, this can cushion movement. In the wrong environment, it amplifies movement. If dealers are set up so that declines force them to sell more as the market falls, then the market is no longer just falling because investors are pessimistic. It is falling because the structure itself requires more supply into weakness. That is a trap. The material I studied described dealer gamma as having collapsed into deeply negative territory, with dealers short more than 7 billion of gamma and sitting near one of the weakest readings on record. Again, most people hear a sentence like that and tune out. I hear something else. I hear that a whole class of participants may be forced to lean the wrong way at exactly the wrong time. If you combine the threshold machine with a liquidity vacuum and then bolt on the gamma trap, you do not need a dramatic change in the economy to get a nasty move. You need only enough pressure to keep the gears engaged. That is why I get so irritated when people say a decline like this is irrational. It is not irrational. It is engineered, not engineered in the sense of a conspiracy, engineered in the sense that the plumbing has rules and the rules create outcomes. The fourth mechanism is the volatility switch. This one matters because there are huge rivers of money tied not to value, not to earnings, not to long-term business quality, but to realized and implied volatility. When volatility crosses certain zones, those strategies do not call a committee meeting. They rebalance, they reduce risk, they sell what they own. Some annuity structures do it, some volatility control programs do it, some risk-based multi-asset systems do it, and because the sums are enormous, once the switch flips, the market no longer needs new bad news. It already has enough internal momentum. In the material I looked at, this was the larger risk still sitting slightly in the future, not fully triggered yet, but hovering near the edge. That is the most dangerous place for ordinary investors. They look at a market that has already fallen and assume the danger is behind them. Quite often the real danger is not what is already sold. It is what is built to sell next, if volatility climbs one more notch. That is why I say the amateur focuses on the drop. The professional focuses on the reflexivity of the drop. One asks, is this enough pain? The other asks, what new seller does this pain create? The fifth mechanism is the dollar magnet. This is the gear most people ignore until it is too late. They think of the dollar as background scenery. It is not background scenery in a stress tape. It is the tightening bolt when the dollar firm's financial conditions grow harsher. Volatility often rises with it. Foreign assets strain, risk appetite narrows, the whole machine becomes less forgiving. In the material I reviewed, the banks expected next. Weak dollar buying against several currencies, especially where euro weakness would mechanically help push the broad dollar index higher. That matters because when the dollar rises in a stress episode, it often works like a second layer of pressure on everything else. I have seen people study individual stocks obsessively while ignoring the one macro force that was making the whole environment more brittle. That is like studying the paint on the walls while somebody turns up the furnace in the basement. If the dollar breaks out, the pressure machine gets hotter. If volatility rises with it, the volatility switch gets closer to firing. If the market slips through the next threshold while liquidity is poor, the threshold machine and the liquidity vacuum combine again. That is why one small chart move can matter far more than the public realizes. It is not the chart itself. It is the set of gears tied to it. Now, once you understand those 5 mechanisms, you stop making one of the dumbest mistakes in modern investing, which is confusing cheap with clear. A stock can be cheaper than it was last week and still be standing over a trap door. An index can be down 8% and still be structurally dangerous. A fine business can be a terrible thing to buy this afternoon if you know another wave of machine selling is lining up just below the market. This is where identity has to change. Most investors in moments like this still think of themselves as forecasters. They ask whether the news will improve. They ask whether payrolls will disappoint. They ask whether the conflict overseas will calm down. They ask whether the Fed will say something soothing. Those are not foolish questions. But in a machine phase, they are secondary. The identity you need here is not forecaster. It is operator. The forecaster wants to be right. The operator wants to survive the sequence. The forecaster says, I think the market should bounce. The operator says, if it does not bounce, what is forced to happen next? That identity shift is one of the biggest rewards in investing. You stop needing to win arguments. You start needing to understand consequences. I learned a long time ago that the market pays you for discipline, not for drama. A good many people want investing to feel heroic. They want the trembling hand, the big bet, the bold buy, while others are fearful. That line has its place, but even that line gets abused by men who have not done the preparatory work. Buying when others are fearful is not the same as buying, while the machine is still finding sellers. Courage without structure is just expensive vanity. What matters is knowing the difference between forced selling that is nearly exhausted and forced selling that is only halfway through its route. One of the reasons I have rarely enjoyed leverage is that leverage turns this distinction from interesting into fatal. In a normal environment, leverage flatters your intelligence. In a pressure machine, leverage confiscates your time horizon. That is the real crime. It takes an investor who could have been patient and turns him into a man with a deadline. Deadlines are wonderful things in business when you control them. They are terrible things in markets when a lender controls them. So the first rule in a machine phase is simple. Eliminate anything that can force you to act. I do not care how exciting the setup looked a week ago. I do not care what your favorite talking head called a once in a generation entry. If a position can drag you into involuntary decision, make it is poison in this environment. Second rule. Protect the core before hunting the opportunity. This is where many people get confused because they imagine caution is cowardice. It is not in a machine phase. Caution is what allows aggression later. I have never met a man who bought brilliantly at the true fat pitch because he had previously destroyed his balance sheet trying to look brave in every smaller dip. Cash is not dead capital when machines are selling. Cash is unspent courage. It is optionality. It is the right to act when the sequence has done more of your work for you. Third rule, separate ownership positions from tactical positions. A great many people mix them together and then wonder why their behavior becomes unstable. If you own a wonderful business for 10 years, act like an owner. If you are trying to exploit a short-term dislocation, act like a trader. But do not tell yourself you are an owner when you bought it because a chat room liked the chart. And do not tell yourself you are a trader if you have no exit plan except hope. A machine phase punishes confusion of identity. Fourth rule, wait for evidence of exhaustion, not merely evidence of pain. This is one of the hardest lessons in the market because people are drawn to blood the way moths are drawn to porch lights. They see a sharp red number and tell themselves the opportunity has arrived. Sometimes it has, very often it has not. What I want to see in these moments is not only damage. I want to see a change in behavior around the damage. I want to see volume swell in a way that suggests real transfer. I want to see a green response that means actual buyers have shown up, not merely weaker selling for an hour. I want to see volatility stop acting like a ratchet. I want to see the dollar stop tightening the screw. I want to feel the machine losing force. Until then, pain alone is not a buy signal. Pain is just pain. Fifth rule, know your levels in advance and know what each broken level means structurally, not emotionally. Structurally, if the market holds, what stays dormant? If it breaks, what wakes up, that is. The way a serious investor writes his playbook, he does not say, I feel like buying around here. He says, if the index loses this area, the machines are likely to push toward full short. If volatility rises through this zone, a larger class of volatility, sensitive sellers may finally engage. If the dollar breaks out, the pressure machine likely gets stronger. If instead volatility fades and the threshold reclaims, the odds of a reflexive bounce rise sharply. That is not academic language. That is survival language. Now, let me tell you what ordinary investors do in the absence of such a framework. They read a few headlines, they average down once, they tell themselves they are investors, not traders. They average down again. Then they check social media and look for reassurance from strangers who are trapped in the same position. Then they anchor to where the stock traded a month ago as if the market owes them a return to that number. Then they begin resenting the market. Resentment is one of the most useless emotions in finance. The market does not owe you your old comfort level back. The market does not owe you a bounce because the decline feels excessive. The market does not owe you symmetry. A machine phase especially owes you nothing. That is why the best reward point in this kind of environment is the identity flip I mentioned earlier. You stop being a dip chaser and become a pressure reader. You stop worshiping the entry and start managing the sequence. You stop asking whether you are missing out and start asking whether the machine has really spent itself. That shift alone saves people fortunes, because what ruins people in correction phases is rarely the first decline. It is the second and third decision made after the first decline. It is the desperate need to do something before they understand what that something should be. The market loves people who need relief more than it loves people who need logic. If you need relief, you will trade for anesthesia. If you need logic, you will wait for evidence. I would like you to think about that the next time a market is down hard on a Wednesday, and every commentator suddenly begins speaking with the trembling urgency of a man trying to sell umbrellas during a flood. Most of them are not helping you think. They are helping you feel. Feeling is not a plan. So let me give you the blueprint I would use if I were standing over this tape and wanted a simple operating system. First, I would decide what belongs to the family treasury and what belongs to the opportunity bucket. The family treasury is not available for heroics. It is built to survive stupidity, including my own. The opportunity bucket is where I can be patient and opportunistic. Once those are separated, my emotions immediately become cleaner. Second, I would strip out any unnecessary leverage and any position size that can bully me into bad decisions. I would rather miss some upside than surrender my freedom of action. Third, I would make a written map of the 5 gears: thresholds, liquidity, gamma, volatility, dollar. I would know before the opening bell what each of them is doing and what would change my posture. Fourth, I would classify every watch list candidate into one of 3 groups: untouchable until exhaustion appears, high-quality names I want if a capitulation event gives me a gift, and businesses I admire but will not touch because the structure around them is still too fragile. Fifth, I would define what a real bottom signal looks like for me, not a television bottom, not a social media bottom, a structural bottom, expanded turnover. Evidence that sellers hit hard and real buyers absorbed it. Volatility ceasing to rise, the dollar failing to tighten further, thresholds reclaiming rather than breaking. The machine losing synchronization. Sixth, I would decide how I will scale. Not one giant act of courage, small pre-planned actions. The market is rarely conquered in a single dramatic trade. Fortunes are more often built by keeping your judgment when other people are borrowing theirs from the tape. Seventh, I would write down in one sentence the kind of investor I am trying to be in this episode. Mine would read something like this: I am not here to predict every wiggle. I am here to preserve capital, avoid forced mistakes, and act when pressure has created value rather than when pain has merely created noise. That sentence matters more than people think, because in bad markets, you do not rise to the level of your hopes. You fall to the level of your system. Now, I want to say something that will bother the people who need constant activity to feel intelligent. Sometimes the best thing to do in a machine phase is very little, not paralysis, very little watch measure. Wait, keep your head. Refuse to be impressed by every intraday reversal. Refuse to be bullied by every red opening. Refuse to be seduced by the phrase oversold when the machine has not yet finished transmitting pressure through the system. Doing very little well is one of the rarest skills in markets. It is also one of the most profitable. There is a reason I have often said the stock market is a device for transferring money from the impatient to the patient. In a machine phase, that line becomes even harsher. It becomes a device for transferring money from the reactive to the prepared. That is why I do not want you measuring success here by whether you buy the exact low tick. That is a childish standard. I want you measuring success by whether you stayed out of the cascade while it was still cascading, whether you protected your decision, making, whether you reserved capital, and whether you acted later from strength instead of earlier from agitation. That is how grown investors behave. Now, could the market snap back sharply from a deeply short machine posture? Of course it could. These systems often become their own reversal fuel once they are stretched enough and some new catalyst interrupts the sequence. I never forget that. The same machine that intensifies a decline can contribute to a violent rally when the gears reverse. That is why I do not build my life around dramatic certainty. But even a possible sharp rebound does not invalidate the blueprint. It reinforces it. When you are prepared, you can participate if the reversal comes. When you are unprepared, you either miss it or you chase it badly. Preparation gives you both offense and defense. Panic gives you neither. That is the real strategic lesson here in the modern market. Your edge is not predicting every event. Your edge is understanding which events create structural flows, which flows are nearly done, and which ones have barely begun. That is engineering. That is investing. And that is where the real dividing line sits between people who merely watch markets and people who are eventually made rich by them. I will leave you with the test that matters. When the market feels like a machine and everybody around you is either guessing, begging, or shouting. Which kind of man are you? Are you the man who needs the market to comfort him before he can think? Or are you the man who can think before the market comforts him? That is the whole game. Because the next decade will not reward the loudest investor, the fastest investor, or the most emotional investor. It will reward the investor who can look at a pressure system without flattering himself. Read the gears, honestly keep his capital intact, and then step in when other people are exhausted, not merely afraid. If you do the old thing, if you treat every hard downdraft like a test of your courage rather than a test of your structure, the market will eventually teach you with expensive repetition. If you do the new thing, if you stop worshiping prediction and start respecting mechanism, if you turn yourself from an opinion collector into a pressure reader, then the same kind of sell-off that ruins other men will become one more transfer of assets from the unprepared to the patient. And that is how you build wealth in a machine age.